So Ajay, some very interesting things are happening on the financial markets, in particular in the debt markets and the US Treasury markets. And despite all the problems in the US with, greater debt, treasuries are rallying and rates are falling. Can you explain what's happening, please?
Sure, I would say that they are more than rallying. They've had one heck of a move over the last week or so. The long bond, the 30-year point on the yield curve, which is where any credit fears should show up, has instead gone up in price by nearly 10 points in 1 week. That sort of move just doesn't happen. I think it's a combination of three things really. One is that people are realizing that growth, at least near term, is likely to be much weaker than they thought even a month ago, 2 months ago, certainly much weaker than at the start of the year. Second, problems in Europe, especially sovereign problems, have come back hard. So I'm sure you've seen serious spreads on both Spain and Italy starting to rise sharply over the last week or so. And the third reason is simply technical. So many people seemed to be positioned short longer rates in the US. So many people were positioned to expecting that longer yields would rise, that a lot of them were just caught massively by surprise. And then these things tend to build on themselves. So I think those are the three reasons why we've had the move we've had.
So despite these sort of problems, and everybody here has been focused on sort of the US problems and debt, despite those problems, when we step back, actually the market's saying there are sort of far bigger problems in Europe primarily. And given that, then we're going to get into the US, and investors are coming here in this flight to quality to the US. So in relatively speaking, the problems in the US seem smaller compared to what now people are focusing on, which is Europe's problems. Is that how you see it?
Absolutely. The problems in European sovereign debt are far more immediate. And I think most people realize that our problems in the US on the fiscal side are solvable with political will.
Might that not all change, though, if there is a downgrade or some sort of action by the credit rating agencies? If that happens, I know there's degrees in which they can act. How would that change what we're seeing now?
I think the near-term impact might not be that significant because, quite frankly, you need ratings from rating agencies if you're looking at smaller companies or more esoteric bonds whose credit you are not able to analyze yourself, right? That is not the case with the United States. Its finances are well known, its balance sheet is well known, and I really have a hard time seeing most people who buy treasuries buying them or not, depending on what a rating agency says.
And can we turn to your first point about the growth outlook? We've had this sort of very weak economic data and revisions down. The US economy looks weaker than we had thought just a few weeks ago. In terms of the bond yields have fallen. How much of that is due to real yields falling, and how much is due to sort of inflation expectations? Would it be the case if it is the real yields, then that kind of plays to your thesis of it's about growth in the US?
A lot of it is due to real yields falling, which means that people are taking their expectations of medium-term growth down sharply. But some of it is also due to break-evens coming off, and the two tend to go hand in hand typically, right? If you expect growth to be really weak, you really cannot expect inflation to stay elevated for 30 years, for example. So it's a combination of the two, but you're absolutely right. The biggest thing that kicked off this move, I think, was people taking a look at where we were after the debt ceiling was over, and suddenly coming to the conclusion, wait a minute, you know what, we were so focused on a debt ceiling, we didn't realize that economic growth is so much weaker than we thought, and we might weaken further because, hey, there's fiscal tightening coming up.
And what is the market implying? What are those market signals implying about the economy and the chances of going into recession now in the US?
I think the market has probably gotten ahead of itself at this point on the pessimistic side. 2 weeks ago, I would have said the exact same thing on the other side. Right now, what the market seems to be implying is that we will grow at very, very weak levels forever. And that just, there's no rational reason to suddenly change your mind in a week or 2 weeks about a decision of that magnitude. So what the market is implying is that there is a significant chance of a double-dip recession. I personally think the chance of an actual recession is still very low.
And just on sort of Europe and the worries there, just to kind of delve deeper into that, the banks in Europe make up a big part of this worry. Are you seeing any sort of warning signals about, as they struggle to perhaps fund themselves in the short-term markets, Is the market worried about anything there? Any sort of alarm bells going off?
Only in the last few days. A week ago or 2 weeks ago, that was not the case. But the thing to remember about the funding markets is that is one of the places where stresses will show up. But unlike, say, September 2008, the amount of liquidity out there currently is massive.
Right.
So even if a bank is having trouble funding itself in the wholesale markets, it might just decide that it doesn't need to. For example, the US banking system, as one example, has 700 to 800 billion dollars of excess reserves with the Federal Reserve, and European banks have $1 trillion of excess reserves with the Fed. So they might just choose to access that if they find problems funding themselves wholesale.
Ajay, thank you very much.
Sure.
Very nice to talk with you, and thanks for your insights.
Thanks.